Hello, folks, and welcome back to another edition of Compound Interests with me, John Najarian. And I am delighted to have one of the most prolific authors on trading that there ever has been. Jack Schwager, folks, the first Market Wizards book that I saw and read was amazing. And then he follows it up with the new Market Wizards, Hedge Fund Wizards, Technical Analysis Wizards. I mean, and I'm not poking fun at you, Jack. You have done a fabulous job. In fact, I guess to a certain extent, CNBC should be paying you royalties for their programs, because what you did was you highlighted interesting personalities in professional trading of all sorts, Forex, stocks, options, futures, and you made it mainstream. And as you did that, the personalities of these people come out in your writing and now in your interviews and podcasts. And by the way, folks, Jack's latest book is Unknown Market Wizards. And I'm sure this one is also great, Jack. I have to say I haven't read that one yet, but it's already on its way to me from Amazon. And it's just a pleasure to have you here, Jack. Jack Schwager, folks, thank you for coming.
Hey, thank you for that introduction. Appreciate it.
Well, it's all true, Jack. I mean, like I say, I started trading on the floor of the Chicago Board Option Exchange. I know you're a trader. I know that you had a real interest in not just some of the methodology, because people were out there trying to write books about the turtles. These various groups, CRT and things like that, O'Connor, and you really got drilled down right to the trader that was doing that portfolio management or that pit trading, whatever it might have been. So maybe if you could tell the listeners and viewers, how did you exactly get started in doing that? And how did you convince these generally very private people to open up and talk to you about this?
Yeah, it's not easy always. It's gotten, I guess, a little easier, because as I've written more of these books, a lot of traders I end up interviewing actually read, one or more of the books when they were sort of getting started, and it was influential. I mean, a number of traders have told me, my books got them into the business. So that makes it easier now. When I first started, I had luck was a big factor, because my first job on Wall Street was as a research analyst, a futures research analyst, and the person I was replacing was a fellow by the name of Michael Marcus. Marcus was leaving his research job to become a trader. Marcus then went on, and we met when he was clearing out his desk and I was coming in, and then he was in New York for a couple of years, and we got together for lunch every few weeks or whatever. So we did have that relationship. Then he went off to the West Coast, and he traded for Commodities Corp, which back in the day was like an incubator of great trading talent. And Michael was probably their best trader ever, I think. He was unknown to everybody, to the world. I don't think he ever did any interviews. Very shy guy. He actually didn't even want to do, even though we were friends, he didn't even want to do this interview because he's such a quiet, such a reclusive, almost reclusive person. Yeah.
Yeah.
And so we both knew someone who worked for more, Bacon Cap, and more capital, and she convinced him to do it. And so it was like she gave that extra last push. So he agreed. And so then I interviewed him, but through him I knew. I was also with Commodities Corp through Michael for about a year, not as a trader, but as a research person. And Michael hired Bruce Kovner. So, for a time they traded together in the same office, probably the most talented duo of traders ever in one office. And, so Bruce agreed to do it. Now, Bruce has not given any other interviews that I know of. And he told me flat out, the only reason I'm doing this interview, and he's one of these people who wouldn't do any interviews, he said, is because there's a lot of stuff about me appearing in the press, and a lot of it's wrong, and I want one accurate record. and he kind of trusted me to do that. So there's two that I knew. Michael, after I spent the day with him, it was like, well, actually, I was there for a couple of days. That is, he was living in Malibu at the time. But as I came to late one day, and then the next morning we began, and through I was interviewing him the whole day, everywhere, walking on the beach, or whatever. And at the end, we were having dinner, and I think I probably still had the tape recorder running. And he had a cook, of course, and cooked wonderful dinner. But after dinner, he kind of pushes back the chair and he says, this has kind of been a cathartic experience. And even though he was reluctant to do it, he kind of felt unburdened, because in that chapter, he goes through his career, which was laden with failure in the beginning. And I think he felt, and he told me he was very honest. I love some of these interviews I've done. People have been blatantly honest, and he's one of them. And I mean, if you read the chapter, you'll see what I mean. And so I think he felt unburdened in the way that gotten all this out. And so he said, who you should interview Ed Seykota. He gets on the phone, introduces me to Ed. Ed is in Lake Tahoe at the time. And I was I had a flight scheduled to go back to New York. But, I said, Ed, I can kind of do it. We'll only have a few hours, but I think that's enough, if we're really focused. Well, I didn't know Ed, 2 hours with Ed, it just doesn't work. So I ended there spending the night, and of course I had to change my, and we talked late into the night. So I got that interview. So there's 3 of them right away. I forgot how I got Marty Schwartz. I don't remember, but I think he came through some other recommendation. And then somebody like Jim Rogers, I knew he taught a business course in Columbia, and I had written this tome called The Complete Guide to the Futures Market, which was like a 750, 800-page book on analysis of the markets. I wrote him a letter saying, look, here's what I've done. I'm not a journalist. I'm just, kind of want to approach this from a more of a, trader perspective. And he agreed to do it. And so, there's a bunch of people writing the first book, and then I got others, but that's sort of how it went.
Oh, yeah. Well, I have found that it's both cathartic for me when I talk to groups of investors that want to become more active traders. And it is cathartic. That's one of the best words to describe it, Jack.
Yeah.
Because then you're opening up and you're sort of thinking a little more deeply about, well, when it's easy to say you got to take your losses and then, take profits, and you've got to be able to do both. But until people have really lived that, it's not the same. It's just like if you watch movies of military folks and you've never been in the military, we can live vicariously through them, but you haven't felt that, that gut wrenching and all the rest that goes with, the bad side of trading. But my gosh, when I look at the roster of people you've talked to, and I do have to ask you this one question,
Sure.
And it's not meant. This is first of all, nothing I do here is gotcha. But do you ever have to vet these guys? Because you've got a guy, this Jason Shapiro, for instance, sounds like a heck of a trader. Allegedly took 2,500 to 50 or 60 million bucks, maybe more than that.
I think he's almost doubled it this year. So I mean, look, that's a great story. About a year before I started, before I even decided to do, before I decided to do the book, at least 6 or 9 months before, I get this email from this fellow, and he tells me that he made, he started out with a few thousand, he made 50 million, and it was sort of like an interesting story. And I say, first thought is, yeah, sure, but maybe, I mean, I've seen a lot of incredible records, right? So it's not impossible. So I wrote him back. I said, well, that's fascinating, but, I'm really not planning to do another Market Wizards book. And I wasn't at the time, but then things evolved and I did decide to do this Unknown Market Wizards. So I wrote him back. I said, okay, I'm doing a book. And if you can send me, evidence. So I literally got every monthly statement from him,
Wow.
Every monthly statement. So, I mean, I mean, unless he's an expert forger, can forge 15 years of monthly statements, to look like the real thing. I mean, so but he's real. He's real. He's definitely real. So yeah, I have to, because I mean, frankly, if I read this book here, this Unknown Market Wizards, it wasn't my book, and I read it, and I would be extremely skeptical. I say, yeah, 300% a year, 12 years. Give me a break. In these markets, who the hell can do 300% a year, 12 years in a row? I mean, on average compounded. I mean, he had one year where he made over 3,000%, so that kind of pulled it up. Otherwise, you probably would only have been somewhere between 100 and 200%. But these records are just kind of unbelievable. I got a Sortino ratio. I don't like the Sharpe ratio, but one of the guys had a Sortino ratio over 20. And that's more impressive than a Sharpe ratio of 20, which I'm sure you know. And for listeners who don't understand that, is because the Sortino kind of doesn't penalize for, it's all based on, it penalizes losses, but it doesn't penalize gains. So when you get somebody like a number of traders in this book, which have huge gains, but still manage to control their losses, you get enormous Sortinos, and the Sortino will be much greater than the Sharpe if calculated correctly, which nobody else, which I don't even say nobody else. I think most people, or almost everybody I see, calculates it wrong. It needs to be, the way people are calculating it, it's overstated by the square root of 2. It's a technical point, I don't want to get into it, but if you do divide by the square root of 2, then you can compare Sortinos and Sharpes. And when the Sortino is higher, much higher, you can tell, hey, this is a trader which has a big right tail, wins much bigger than the losses.
Now, Jack, I think a lot of people that are going to be both buying your books, and they should buy these books, folks. There are great books. You will find yourself highlighting parts of each chapter, because some of them will speak directly to you, and some of them will be just cautionary tales in some regard. But what you'll find in these books is that there was no one single way that these traders made money. Now, they may have had commonality in certain areas, but if you could, Jack, the best of the best that you spoke with, and now that you've got this arm that sees traders as well, what would you look for as far as traits that you think a trader really needs to have? Not the methodology, but the traits that trader needs to have to be successful.
Yeah, John, you've stated it perfectly, because it's exactly that. It's not the methodology, because the methodologies are all over the map. I mean, everything you can think of, pure technical, pure fundamental, mix of technical, fundamental. In this book, somebody who's neither technical or fundamental, short-term, long-term, currency traders, stock traders, both trading both, it's just like a complete mix of different approaches, right? And almost, I mean, if you took all the traders in all the Market Wizards books, you'd find very few that are kind of similar. In this book, there are a couple that are similar because they came through the same prop shops, and they do have some similarities, although they evolved also to be different, but not as different as typical. But as you said, there are commonalities, and those commonalities have nothing to do with methodology. It's a point to be stressed. What they have to do with, so what are some of the big commonalities? The big commonalities are, first and foremost, risk management. Almost every trader I interview pays enormous attention to risk management. They'll tell you that it's more responsible for their success than their methodology, but it is critical. It is critical, okay? It comes up again and again and again. Having the discipline to stick with risk management and to stick with a methodology that's working, that discipline, which involves a lot of things. It means you don't take trades that are not part of your methodology. It means you don't take, gut trades just because you don't take trades because you're bored. You don't decide to give the market more room, or what we called in my day, cancel of close stop orders. You don't do all these things. You don't You don't lose money in the market, take a big loss in the market, say, I'm going to get it back from that market, which is, the revenge trade, which is all of these human emotion things, which just are all detrimental. And so you need the discipline to kind of shut that out, to not fall for that. You need an edge, okay?
Yeah,
So,
well, that's where I was going too, because I know that's one of these things that you always, say you've got to know what your edge is. Mine is, for instance, unusual option activity. That's my edge. Like you said, Warren Buffett says he's going to buy something that he can hold for 10 years if the market shuts down. He's that confident of the management team and the space that business is in. But, there are a whole bunch of other edges that people have, whether they're quick twitch traders or buy and hold. So how do you discover what your edge is for a trader?
Yeah, it's going to be different for everybody. But I would want to say one more thing about the importance of an edge. It's, if you don't have an edge, then you're the player at the roulette wheel, not the casino. And you can't win in trading if you're the player instead of the casino. So you have to be the casino. And the casino in most games, with exceptions like slot machines, which are the worst of all. But for a game like blackjack or roulette, it's a few percent. But the edges aren't huge. So if a trader doesn't have to have an enormous edge to do quite well, but they need to have the edge. So the expected gain has to be greater than 50%. And so how do you get that? Well, every trader evolves to discover their own edge. In this book, you got Peter Brand, whose edge is to, generations worth of experience with charts and pinpointing points where he can take a position and have a reasonable shot to get a good swing up or down, and be able to do that with a meaningful stop that's relatively close. That's what his edge is. If you somebody like Jason Shapiro, who's a contrarian, a pure contrarian, his edge is always being on the opposite side of what has been a major trend. But he uses the CFTC, Commitment of Traders reports, but he also uses market behavior. So what he's trying to do, he's trying to, we're in a zone now where this market is overbought. Doesn't mean you go short, because your market can keep being over. But then he waits for market action that confirms it, or other people that he sees that he knows, do the wrong thing, confirming it. That's things like that. So he combines that. We're always with risk management. Otherwise, you can get carried out being a contrarian, obviously. You've got people, a few of the traders in the book are event traders. So they'll really prepare for stuff like central bank announcements and other types of economic events, and know exactly what they're going to do depending on what number comes out, depending how the initial response is, and that's their edge. So everybody develops their, and you nor I can tell anybody what their edge is. In fact, in my case, and I don't have much of an edge. I'm just a small edge because I'm not a very good trader. But whatever edge I have is because I learned risk management through doing the books, and maybe my chart approach to this has a little bit of an edge, tiny. I'm not a good trader, but that's my edge is just having a little bit of an edge through the charts, but using risk management. So I've got an edge. That's what it is. But I'm not a good example because I'm not a market wizard. But everybody has to discover, what their edge is, and for everybody, it's going to be different.
How about the psychology of it, Jack? Mentally, how you deal with success, because that can screw up and has screwed up a ton of traders, obviously. And not just buying a new Ferrari or something like that, but, basically thinking it's going to go on forever the same way it is right now. It's one of the reasons, Jack, that when I traded actively on the floor, I never really took more than 4 days off because I didn't want to miss it. And I don't mean miss it from a junkie standpoint, like I'm addicted to it, but I didn't want to, I knew at some point it would stop. and I wanted to be there to take as much as I could, rather than saying, well, yeah, I've done really well. I think I could sort of lay back and go to a beach. One of the things that I really worried about, Jack, was that I would get too civilized, because trading, especially floor trading, folks, is so different than investing and trading from upstairs, because you're in a pit, sweaty, smelly pit with a bunch of, traders that are, willing to do almost anything to make that buck, even though they're extremely trustworthy. I think, some of the most trustworthy people I know, Jack. I mean, I know guys that wrote me $500,000 or $1 million checks, and I did the same for them if they were in trouble. And without all the lawyers, without all the other stuff, just because your word was your bond. But on the other hand, you had to have that killer instinct in the pit, I think, to really flourish, at least flourish in the pit. Didn't mean you needed to be, a bad person, but it meant for me and for my brother Pete, just like Carl Icahn said, if you want a friend, get a dog. When he was fighting with Einhorn about that, that trade in Herbalife. And he said, hey, you want a friend? Go get a dog. Or was that Ackman? I forget now. But I mean, those are classic, Carl Icahn-isms. But I thought it was all very true that you had to be able to deal with the winning as well as the losing. And you've seen lots of examples of both with the people you interview.
Right. Yeah. I mean, so psychology and particularly in this book, I mean, it comes up in every book. When I wrote the original Market Wizards book, I thought I was going to be writing a book about markets and trading. In retrospect, it's probably more of a book about psychology than it is markets and trading. And that kind of repeated. But it was good that I went in. I went with where the material was, and I didn't necessarily know what it was going to be, and I took what I thought was the most important stuff, which often happened to be the psychological stuff. So yeah, and it comes up maybe more in Unknown Market Wizards than in any of the books, where you have one trader who will prepare for a trade, like he's one of the event traders I mentioned, like a professional athlete, and he'll meditate, he'll do breath work, and he's before this he's done all this research, so he knows he's got his whole plan on how he's going to trade this event, and then he'll get himself into what he calls a deep now state, and he's totally focused on that the world doesn't exist outside of that screen, and he knows exactly what he's going to do. And if he puts a position on, it's going to be in size. And he knows because these are, in fact, I call that chapter, I think it's called Unicorn, it's Unicorn Trader or something like that. Not the Unicorn Trader, but Unicorn Sniper, because that's the way he trades. He's got a few big trades he's going to get in the year, and he's going to really hit them hard. And he's going to be better prepared than anybody else in the world on that trade, literally, I think, and because he doesn't focus on doing a million trades. In fact, one of his points is that those other trades are distractions. You really want to focus on the really good opportunities. So when he has one of those, he gets into this mental state where he's just totally there. And if he's wrong, he knows he has the discipline to get immediately out. Because the size he's in, if he's figured it out wrong, the market isn't behaving the way he thought it would, he has to get out right away, because he'll get carried out. So he's got an approach. He can never let his discipline lax even one time. But it's all it's his mindset, it's his discipline, and psychology is super critical. Yeah, he does a ton of research, and it's not only another trader keeps literally an Excel sheet every day. He's got a bunch of different columns, for things which might be emotional types of things, like and he checks off, like he'll have, like, just to give an example, he has one column called a sugar trade. The sugar trade is a trade you take because you kind of just want to take it, but you really have a good reason to take it. So if he does, that's a mistake. Even if it works out, it's a mistake, because that's not his methodology. So if he does one of those, he'll check it off, and he can see at the end of the week where is he emotionally weak or emotionally failing, so he can focus on that. So he literally does it with a spreadsheet. Also keeps daily notes on his emotions. So, psychology is super important. You got to know where your weaknesses are. You got to avoid those. Every trader, probably every trader has certain types of things they tend to do wrong or get suckered into doing. By when I say suckered, I mean by their emotions, right? Our emotions are always driving us to do things that are not good for the bottom line. They may feel good, may give you a bit of excitement. It may take you away the boredom and whatever, but they're not what you should be doing. And so controlling that is really critical.
Jack, what about one of my favorite interviews that you did was with, I think, Paul Tudor Jones. Now, obviously legend, but a living legend, much like Stevie Cohen, who's just buying the Mets now with some pocket change, I guess. Whenever he's not buying a shark in formaldehyde, he's looking at baseball.
I never understood that one, but I guess I just don't get more than that.
No, I don't get it either. But he'll probably make money on it, but I just wouldn't want it in my house.
Yeah,
but I've met Stevie, have talked to him a number of times. Good man. But Paul Tudor Jones, here's a guy, coffee, sugar, cotton, I think. Were more or less. Yeah, I think it was it Louis?
His early days, particularly cotton, because he came from a family, that had, was one of the main merchants, I believe, or at least I think his uncle or whatever. I don't remember. It's been 30 years since I did the interview. But he had, but I think he talks about Tullis, who was a famous cotton merchant, about what he learned from him and how he sat in his office in New Orleans, I believe, and he would have a day where he'd have take a big loss, and then he had visitors, and the visitors came, and he said you couldn't tell that he had a losing day. That really impressed him and stuck with him. And so so that was one of the main markets. He also had his worst trade ever by 10,000 miles was a cotton trade. Almost knocked him out of the business, one trade. And that's in that interview. It's also the trade that brought him the religion of risk management. He came about as close to getting knocked out of being a trader as you could. Which happens to so many of the traders I've interviewed. In this book, I have one who actually finally quit for a couple of, but then a few months started again. Actually, two. I'm thinking to two traders who did that. So I got two traders in this book who quit trading and then came back to it again. Even though they were very successful, but they hit a period where things were not going right. It was too demoralizing. They just couldn't take it anymore. They stopped. And in one case, it was an 11-year hiatus, I think. In another case, it was like a three-month hiatus. Yeah.
Wow, 11 years. That's forever. When we talk, my brother Pete and I, Jack, are partners together in this firm, Market Rebellion. And when we do conferences and things like that, we got to get you out to one of those, by the way. We'll talk to you about it offline.
Yeah.
But when we do these, one of the things that we tell people is when you're not finding your groove, when you're not hitting as many hits as you need, because we all have losers. And I talk about that a lot. But people on Twitter, of course, come after me all the time, Jack, because Twitter's a cesspool of people who, have nothing better to do. But they'll universally, they'll say, why don't you talk more about your losses? And I'll say, because I'm not shitty at marketing. That's why. I mean, I will admit to losses, but do you really want to invest with the guy that's constantly telling you, well, I lost 20,000 on that trade, vaporized, I lost 50 over here or whatever, because that happens. But I never put a number, by the way, Jack, when I'm talking to our traders or when I'm on CNBC, I never say, oh yeah, that was a $100,000 winner. That was, a $20,000 loser. Rarely, on rare occasions, I've said that about the losers, but I never talk about the winners as far as putting a number to it. I'll say I had a lot of that and it worked out, or I bought a lot of that and it didn't work out. But when things aren't working out, we do, maybe because Pete and I are sports guys, And you're obviously living in God's country out there, cross-country skiing. You're a sports guy.
Yeah. Solo sports, yeah, not team
Staying
sports.
in good shape. Well, when we say when it's not working, shorten up on the swing. So if my hand is down at the end of the bat when we're playing softball, I'm going for a big hit. Might not work, but because of the odds, people on bases here and there, there's only one out. If I can get it far enough into the outfield, we'll score at least two of them, that kind of stuff. When we're doing that, then I'm swinging harder. When things aren't working out in trading, we say same thing that you do in the major leagues if you're a baseball player, folks. Shorten up the swing. Don't come from as far back. You just need to make contact. You just need to make contact and get that feeling back. In your interviews, did you get that from any of the guys or gals that you've talked with about, how to get your swing back?
Sure. I that question comes up in many interviews. I don't know if most interviews, but many interviews. And it's basically the question, when everything you're doing is just going wrong, what do you do? So it's like that's the question. And one of the answers, indeed, is you're shortening up on the bat is a perfect analogy, because the answer is you reduce your size. I still remember this, Randy McKay from I think he was in the first Market Wizards book, who also made a transition from floor trader to office trader. But he said he's gone from trading as much as 2,000 contracts, in currencies, to trading 10. If his things are not working, he keeps on cutting his size and cutting his size. So at some point, given what his size he was trading at, if you're trading 10 contracts, it's nothing. So another common answer is just, maybe even more common, is just stop trading. Just liquidate everything. Take the afternoon off. Take a week off. Take a vacation. Just stop doing it. The old cliche: if you're in a hole, don't keep digging. So if things are not going right, the market's telling you whatever your approach is just not going right now. So plus it's a tendency that for people to get into this very negative cycle where they lose and then they beat themselves up for it, and then they have less confidence and more likely to lose again. So if you're in that type of cycle, the best thing you can do, if you're not going to really, some people can't reduce, they're not trading large enough to reduce size maybe, but the best thing you can do is just, like I say, liquidate everything. The markets will still be there, and come back when you feel refreshed and and you're ready to go again, and you think you're going to win again. And then start small, and when it's going, continue to build back to your normal size. So those are the basic answers that I get to that type of question, which is, you're shortening up on the bat swing is a good analogy.
How about you also use some of these analogies from the military, like fighting the last war, when somebody is looking at their past performance. And saying, okay, yeah, there's nothing wrong with back testing. I got nothing against it. And there's nothing wrong with remembering how you made money last time a certain set of circumstances presented themselves. Like, for instance, volatility spiked just 2 weeks before the election this year. And it was, we thought, a great opportunity to buy stocks rather than to get out of stocks. Because I guess, like Jason Shapiro, Pete and I are sort of contrarian investors in that we view high volatility, Jack, as a time when the market's fearful, like Buffett says. Market's fearful, that's when I want to buy. When the market's greedy, that's when I want to sell. So when the market's greedy, generally vol is really low. Now that doesn't mean I want to sell calls against my stocks. That means I want to get out of my stocks and get into call spreads or calls because they're cheap when the vol is low. When the vol swings and it's on the high end, like I say, that's when I'm saying, okay, there's blood in the streets. Apple's back to $106 a share. I'm going to buy that stock. I'm going to buy this stock, that stock. And then as it rallies, I'm going to trade out of the stock and get into an option spread as the vol drops. And it doesn't always work as perfectly as it did this time, but that muscle memory from trading is that when we see spikes in vol, they don't stay there very long, generally.
Yeah.
We had a prolonged period of pretty high vol in
March.
March and April, as we came into the pandemic this year. But having experience with that, we were always looking for, okay, where's the flush? Where's that, time when you get that capitulation and people are just saying, I'm done, and it happened at least once or twice in a big way when the market was down like 1,800 Dow points or 170 S&Ps or whatever it was. Those kinds of moves, and you've seen them. Having that muscle memory of living through it in the past is something you can draw from. But like you say, you can't fight the last war. If you've got all your weapons built for fighting what worked in the last war, it might not be the right setup.
Well, you basically use an approach as long as it's working. And if it's not working, it might be a temporary thing or it might be a more permanent thing. And, that's the difficult part. But we want you to phase where it's not working. You have to be a lot more cautious and you have to be open-minded and, and consider that maybe this is not going to work anymore. There's one of the traders, the only systematic trader in this new book, sort of had developed basically trend-oriented systems. And he had I don't know if he had 2, 3, 4, so it's just a few systems that he traded. And he came into trading because he's a software guy. So he had everything programmed. And so he could, through his career, he's traded God knows how many systems and he's tested, who knows how many more systems, but he can pull up any system and have the complete equity from when he first developed it to current day. So he made this major shift where these systems that were making money from in those initial years for, consistently every year just started losing money. And he had a hypothesis that they were just too slow, that the markets had speeded up, that now taking for what his were shorter term systems, taking the signals on a close was just too late. And he sort of revamped his systems to anticipate what the close was going to be and anticipate what the volume was going to be. So, based on the early trading, projecting out, and then would use that. And then he started making money again. But I said, well, out of curiosity, these systems that work so well that you abandoned, how'd they do? And he pulls up the chart. And it's the most amazing thing I've ever seen. It's like a straight mountain chart up to a point in time. And then it starts going down. And it hasn't stopped going down in 8 years or 10 years, however, I forget when it was he switched. It just, from that point on, it just kept on going straight down to the current day. You would have lost money every year if you kept trading it.
Well, it sounds like he made the right move then.
Oh yeah. And but he not only he made this type of move one, he made it in a chapter. You see, he made it multiple times. And so if he had stuck with his methodology at any point in time, he would have been wiped out. He would have been wiped out really. So it was only his flexibility to be able to say, okay, this isn't working. I got to find a different approach. And that's how he ended up, with a good winning record. But if he had stuck with his systems at any points in time, multiple times, it would have worked out badly.
Folks, Jack's latest book is, again, Unknown Market Wizards. And I want to give you a quick chance, Jack, before we wind up, to talk about FundSeeder.
Sure.
Because this is a firm that Jack is at least co-founder. Maybe you're the founder.
The head guy is Emmanuel Villari, whose idea it was, and who asked me to join him. And so, so we are kind of co-founders, but he's the CEO. He is the larger. He's the one who has more direct, involvement with the firm. I'm a co-founder, but he has a higher role. So FundSeeder was his idea, and he popped it to me. I knew him because I was advising him and his company on a portfolio, of CTAs. And so we were at a conference, and he says, Jack, I want to pop this out to you. What do you think of this idea? And essentially the idea is, what if there was a global sort of place where any trader in the world could link their account and, with their broker, and the accounts would therefore be verified. And if they had trading skill, they could demonstrate it through their track records coming direct from the broker. And so people who normally wouldn't have any chance of managing money would have an opportunity of being discovered, no matter where they are. I like it. In fact, 4 traders in this book came from Fundseeder. But I'll take the most extreme case. This trader is a fellow who lives in the Czech Republic. His highest year of education was high school. He admits he didn't even get very good grades in high school. Went for a year of military service after high school, then had a 10-year career as a bellhop. Seeing all these businessmen in Prague, reading the Wall Street Journal and thinking to himself, boy, I'd like to live like that. Nice job. You just look at the paper and you trade, you put in orders. But anyway, I mean, his first time he failed, but then second time he hit upon a methodology, which works, for 15 years now. And so a trader, and he has really excellent, he compounds at somewhere in the 30% a year. He trades large cap stocks, so the technique could be applied to much larger portfolio. He just basically he keeps on living off his winnings, so he's never growing, but he's not managing money. But a guy like that, even if he had an approach, and I say an approach, his return risk is better than at least 99% of professional managers, in terms of pure return risk. But he would never get in a million years, he wouldn't get anybody to pay attention to him. Czech Republic, high school education, talk about having the wrong pedigree, right? So,
Right.
So that's the idea for Fundseeder was that people who have trading talent could get discovered. And so Fundseeder.com is a platform for traders to ideally link their accounts to the site if they're not every broker is linkable, but if the broker is linkable. And it has all sorts of analytics, so they can, get all sorts of performance, equity charts, all sorts of return risk measures. They can even do technical analysis on their equity curve, stuff like that. So that's there as a free site, because our monetization objective is not to charge traders linking to the site. It's to find undiscovered trading talent that we can then, which we're now in talks with some large entities. I can't mention who they are, and but any of those, there's two really big entities, big allocators. Anybody would know who they are, almost. But if assuming that we can get a deal that goes through with one of them, at least one, maybe both, then we don't want to reinvent the wheel. It doesn't make sense. You've got these professional operations that have all the software and manpower to execute the stuff. It doesn't make sense for us to try to form a fund or something like that. It's just too expensive as a startup. We can't do it. So we decided we're going to the game plan is to partner with one or more large allocators, and then we would then get monetization that way. So anyway, that's Fundseeder.
That's Fundseeder, folks. And for any of you who are aspiring money managers, you should check out that site, because again, just as Jack said, it doesn't cost you anything, but you link your brokerage account to it. They would track it. It produces graphs and everything else, I think, Jack.
Yeah,
So that you can see
underwater charts. A lot of neat stuff. I basically designed it. I designed the analytics the way I wanted. So on a theory, you build what you like, and if other people don't like it, that's too bad. But you don't want to try to figure out what everybody wants. It's just better to do what you think is good. And so I think it's a really good site that way. I should add, if your account can't be linked, we do have a facility where people can download a template and then essentially just cut and paste their hopefully daily numbers. That's what we primarily use. But we also have the facility to just download, to do that with the monthly numbers, cut and paste from Excel and then upload it. And so but then those accounts show up as non-verified. So on the site, there's verified accounts and non-verified. Non-verified doesn't necessarily mean people are pulling a fast one, obviously. I think most of them are legitimate, if not the vast majority, but it means that presumably those people are with a broker where they couldn't link. So so they can still use the site.
Beautiful. Jack Schwager, I can't thank you enough for being with us today, sir.
Hey, enjoy it.
I love the stories. Next time, we're going to talk about algorithmic trading and how it's all programmers now instead of traders.
Yeah.
But because I know you know about that side of the business very well, too.
Yeah, I bet. Yeah.
Thank you for joining us today, Jack. It's a pleasure. Unknown Market Wizards is the newest book, folks, but he's got, half a dozen, maybe more books than that. The most prolific author in the trading space, Jack Schwager. Thank you, Jack.
Hey, thanks. Appreciate it.
Very much so.